Once upon a time, long before climate targets and dashboards, there was just this, a piece of land. It drew life out of carbon without a price tag. It held water without a contract. It sheltered species no one had ever counted. But over time, something changed. The land became worth more when it was harnessed, emptied, and sealed than when it was alive. And then humans did what humans do best. They invented another number.
We call it EII, the Ecosystem Integrity Index. A single score to ask, hey nature, how are you doing? The EII tells many stories. The carbon still stored in forests and soil. The species that remain or return. The water held, filtered and released. And the stability this land gives to nearby people.
For a long time, I was invisible in your balance sheets. Trees were timber, soil was dirt, wetlands were just unused land. Now you've given me a number, EII. It is not my whole story, but at least it is a language you understand.
Imagine now. This number does not stay locked inside reports, but begins to move capital. Imagine each of these tiles as nature stocks. A defined unit of land, with a living EII score, with a plan for recovery, and a claim on the future value healthy nature can create.
When capital follows my EII, you are no longer just buying a permit to pollute. You are investing in my recovery. My forests thickening, my rivers clearing, my species returning.
Imagine now, we move forward in time. By 2050, if portfolios follow EII, millions of hectares can move from degrading to regenerating, reviving the perpetual delivery only nature can grant. Carbon can stay in living systems, creating tradable assets. Species can reclaim lost ground, strengthening supply chain resilience against pests and diseases. And communities can build profitable livelihoods on restored land, turning nature recovery into measurable financial returns. And that's what conservation by the Landbanking Group already looks like today.
And when you hold high EII nature stocks, you are not just holding risk on a warming planet. You are holding resilience. You are holding the recovery you chose to finance.
Once upon a time, this land had no number at all. Tonight we ask, what's the EII? The real question is, what will you do with it?
Let my EII guide your capital, and I will do what I have always done best. Turn integrity into life.
Thank you, Felix. What an opening. And thank you for joining us for the stack. Why the stack, I have been asked. A stack layers complex science, complex technology, complex solutions, complex standards, complex rules behind one trusted interface. So something that was very hard in the past all of a sudden becomes easy, it becomes repeatable, it becomes very accessible to everyone. And nature, let's face it, is a very hard problem to solve. It's in fact the interaction between economic systems and natural systems. It's the hardest challenge of our time. It's the hardest challenge I came across. My name is Martin Stuchtey. I'm one of the founders of the Landbanking Group, and I'm speaking on behalf of the Landbanking Group's team today, but also on behalf of World Conservation Society, who is agreed to have this session together with us. And they have inspired us through their work, and many of you in the audience today have inspired us with their work as well. We are a proud part of the global nature tech community. Now, we are very glad you are here because there are other things happening. Let's face it. Sometimes I wonder how we will be looking back in 5 years' time, 10 years' time, to that 21st of January 2026. Of course, we don't know, least of you, of all of us, myself, but I'm deeply convinced that we will ask ourselves how we have reacted to the circumstances back then. And the one is, have we spoken up? And thank you, some of you, Johan, Carlos, Paul, others, who've just spoken up on all of this, representing a different type of future that we want for ourselves. And secondly, have we acted up? Have we done something that shows that this model of generating prosperity is in fact the better one? Have we created the rail tracks credibly for that next economy? Have we shown that this is politically possible, economically attractive, and intergenerationally meaningful? That's closer to the topic today. Today we want to talk about a new opportunity that has arisen and that talks to our overwhelm and to our underwhelm. Our biggest overwhelm, how can we actually deal with that complexity as we interact as humanity, as an economy with nature? It's also complex. Science is so complex. Technology is so complex. And secondly, how can we deal with our biggest underwhelm, how we have been unable for many years to actually draw the appreciation, the rewards, and the capital back into that critical infrastructure called nature. I found an article that we wrote 10 years ago by the week on Sunday, where we talked about nature as an institutional asset class. The idea has been around for quite a while. Still, we haven't been able to mobilize it yet. That might change. There's a new possibility, and that's what we want to talk about today. That possibility has been given to us by the work of ecologists, ecosystem modelers, by agronomists, by data scientists, remote data providers. So we have a new gift given to us, and that's what we want to talk today. We have 90 minutes, so let me delve straight in and only quickly say what we are going to discuss, how we want to have this discussion, and who you are going to meet. We want to present 3 ideas that we feel are needed to build the nature stack. The first one is the Ecosystem Integrity Index. It's a big gift that has been given to us, by the United Nations World Conservation Monitoring Center. They have been brought up this methodology a long time ago. And secondly, it's a gift of modern technology that allows us now to make it relevant to every pixel of the planet. Secondly, we want to talk about what we can do with it. We want to present the nature risk pricing models. How can we actually start to show how better nature reduces risks, and that therefore we can price capital differently? We can reward nature for her resilience. And thirdly, we want to talk about nature stock pricing, a new way of holistically looking at nature for the potentiality that she is giving us in the long run. So this will be a very deep conversation. All of these 3 points have something in common. They are needed to build the nature stack. Secondly, they already work in practice today. And thirdly, they are given to us by the nature tech community. Now, and then we want to discuss how, there are many different ways to offer how to have a discussion these days. Threatening each other is one popular form. Instantaneous agitation is also a very popular form. Let's do it differently here. I like the conversations that you have in an academic review board, where someone proposes a substantive idea and then we all wrestle to bring it forward and to improve it. Let that be the spirit of today. Finally, who will we be talking with? The nature tech community is in service of something bigger. It's not about the technology, it's about the technology being in service of something bigger. So we need others to help us. First, we will be discussing, and Sonja will be doing that, with those who are helping us to define the standards, to harmonize indicators, and to and to drive a convergence so it's easier to interact with nature. And then secondly, we need to listen to the users who are dependent on nature, the banks, the reinsurances, the investors, the landowners, but also the governments. That's the second part that I will take care of. But for now, let us get started and talk about the Ecosystem Integrity Index. Thank you.
So I learned sometimes you have to go slow to go fast, and here you have to go back to be seen. So delighted to have all of you here. As Martin said, there were other options in the mix, but I'm super delighted to start with that base layer, the fundamental knowledge we need to have to appreciate, evaluate, and invest in nature. And I would ask Benjamin Leutner, Jessica Smith, I just go with first names, Tony and Fiona, please, everybody knows you anyways. Join me up here. And I have to fulfill a promise right from the start. I promised all of them that they are part of the crowd because we're working on this together. So Felix, you introduced the cap. You've got one, but I give you one anyway. So Benny, maybe we start directly with you. It's the Ecosystem Integrity Index is nothing that the Landbanking Group came up with. It's the UN WCMC. But why actually have you chosen to put all your coding efforts to make this come real for the bigger community?
Yes. So when we set out, we were on the search for that one number that we can use to underwrite all of these activities, all of these other layers that you've seen. If you know a little bit about us, you know we have a platform, we do nature monitoring, we have hundreds of indicators. But consolidating those into a single condition assessment, that is really hard, picking which one to choose and so on. So we went down a bit of a rabbit hole and did a review on which candidate indices are out there that we could use. And we have some very clear requirements on things that we need to fulfill. So we need something that is scalable, that we can compute everywhere on the planet. We need something that we can calculate repeatedly. So not just once, but next year and next year and next year. We also need something that responds to actual changes on the ground. And that's something where a lot of global indices fall short on. Say you have an index that captures an agricultural landscape. If in that landscape you start planting hedgerows, most global indices won't respond to that. But that's of course a requirement if we want to make it really local, if we want to make it really actionable. And lastly, we needed an index that you can understand. So it is not just a black box model, but that you can, at least to a degree, decompose on how did that come to be? Why is it a 0.5 and not a 0.4? And after this review, we ended up with the Ecosystem Integrity Index as one of the established, well-presented proposals that fulfills most of these buckets. We evolved it a bit further to, in particular, to bring in this local actionability. But that was at the end of the day of our that was our choice, and I think that fits pretty well. And just as a quick explanation for anyone who has not read those the preprints and so on, it's an index that goes from 0 to 1. 0 meaning perfectly degraded, 1 meaning perfectly intact. And it consists of 3 subcomponents. It's compositional integrity. How close is your species composition to an expected natural state? It is structural connectivity, structural integrity. How connected is your landscape? What is the spatial structure of habitats? And it is functional connectivity. How well is that ecosystem functioning to what we would expect in an unmodified state? And all of those we pulled together. We built also here, we built on existing data sets. For example, we used the Biodiversity Intactness Index, published and reputable for the compositional component, Some of the modules we had to build ourselves for functional integrity. We use state-of-the-art satellite monitoring of primary productivity. And putting all of that together gives us, at the end of the day, this one number. And then we added on top of that a second layer that allows us to use local assessments, local habitat structure, for example, local water KPIs, to modify that index slightly to make it really responsive to what's happening on the ground.
Thank you. Jessica, it was supposed to sound very easy, and somehow it sounded complex again. Do you think your colleagues from UNWCMC have laid the foundation for a real step up in the finance world to embrace that number or an index, to understand it's just like a rating? We now get to a point where we can understand an ecological asset just like other assets.
Great, thanks, Sonja, and thanks so much for having me today. So yes, I work for the UNEP Finance Initiative, and we're headquartered in Geneva, and the UNEP World Conservation Monitoring Center is based out of Cambridge. Actually, some years ago, I used to work there, and I think the WCMC colleagues have done a great job in terms of addressing one of the main challenges that has been preventing further growth in this sector in terms of the nature finance space. And having a single number allows for comparability between very wide contexts. So I think in many respects, this is a breakthrough. In our membership platforms, we have around 385 banks. We have around 200 insurers, reinsurers, and support organizations for the insurance sector. And we also work with many asset managers, asset owners, financial regulators, and supervisors. And to have a lingua franca amongst those parts of the financial sector helps them to move in tandem. So we can get better coherence between the various moving parts of this sector, and having a single number that can communicate across multiple different levels can be a game changer in that way. I would say one thing that would be quite important over the coming months is to have different user groups trialing how it could work. And for example, we've been working with Oxford University on a project using Earth observation data in different nature finance product types. And I think that kind of exercise is really revealing to see how it can bring that operational function to the product, and also, where are the points that need to be smoothed to be able to see how it applies to different asset classes, how that translates at a portfolio level, whether it can be linked to loans. And I think now that there is, this great platform and there is, a very strong start point, we can get that work of testing, implementing, and I hope that it will break through. But the breakthrough is through multiple, like a flood, through multiple channels all across the industry.
Thank you. That's actually the absolute ambition. That's why it's open source, not only open data, to really get into the weeds now and test where do we need to improve, how do we collaborate, how do use cases fit. And Fiona, maybe I can just jump to you. As in the World Business Council for Sustainable Development, you gather all these different corporate actors who have very, very specific use cases. And if there has been one thing I've learned over the last year in this space, it's so complex and difficult because biomes are different, regions are different, and our specific use case, how we use land, how we use ecosystems, how our landscapes are influenced by us and how we depend on them is very different. What's your take on this need of specificity versus we also need to understand on a global level?
Thank you for a tough question on a very, very tough challenge. And thank you, too, for inviting me to be part of this incredible conversation and these developments. I think what we've heard from Jessica and what we know is that this is a systemic problem. And what we see also is a systemic disconnect between the recognition in the financial system that's coming through from the prudential regulation into the asset management and the capital allocation to the real economy. And that is why we need these types of credible data sources and credible, reliable methodologies, because that will help us trace through to the ground, literally the ground, where these impacts have been felt and where these risks have to be managed. And obviously that translation layer is the corporate world. Financial risk management tends to, forgive me, happen on an Excel spreadsheet. But the risk management really needs to happen on the ground with the people who use the land and interface with the land. So we've been delighted to see such enthusiasm from our membership on leaning in on this. We've done roadmaps for TNFD and have been very supportive of TNFD's work. And we continue to work as they try to integrate this into their decision-making and ways of working. But it's hard, especially the further up the organization you get. Because the further up the organization you get, the more you are competing for one, understanding, but also the broader agenda that is so relevant to executives today, not least what's happening down the road as we're talking. And so as you do that, the more reliable the data is, the more predictable the outcomes are, the more clear you can be on the use cases and the value of it, the more you will drive the investability and then the business case. And that's when we get that terrific feedback loop that we so urgently need to drive the investment in nature to really help improve and hopefully get to a restoration profile.
Thank you. That was a nice segue to Tony, CEO of TNFD. This question of, well, it's a journey. TNFD has described it nicely with that LEAP journey. You need to understand, you need to get real transparency, not only where you are, but what your impact is, what your dependencies are, where your risks and opportunities lie, and how to implement that into your decision process. Just how does that resonate, and how does that maybe support the idea also of the Nature Data Public Facility that is basically hosting such a wealth of data that companies can dive into and make sense of for their decision-making process?
Yeah, thanks, Sonja. I think it's maybe worth starting with where's the demand signal for this. I think despite all of the geopolitical turmoil in the world at the moment, we've actually, at TNFD, had a pretty remarkable year last year where we've seen engagement in this agenda just continue to grow and grow. So my take at the moment is people are putting their head down and doing the work. Obviously, a lot of companies don't want to be shouting from the rooftops about what they're doing on sustainability right now for various reasons. But we have seen continued engagement on this agenda. So just to give you some numbers, we're now over 700 companies that are now doing TNFD reporting, about $22 trillion in assets under management. And there are already 500 TNFD reports that have been published. In fact, some companies this year are going into their third cycle of TNFD reporting. So I say all of that simply to say that solutions like the one you're building, Landbanking Group, and using EII, there is a demand, there's a need. And I think as TNFD, our job is to sort of survey the landscape and figure out how can we help to enable that to continue to grow. We're both trying to provide the tools for people to take action, but we're also trying to remove the reasons for inaction. We've heard a lot about data and metrics as being reasons why this is perceived to be difficult. And yet, we have 700 companies that are voluntarily committed. We've seen 500 companies do reporting. And I can tell you that across the 14 recommendations we've put out, there's fantastic traction on nearly all of those 14 disclosures, whether they're qualitative or quantitative. So all of that is to say there's fertile ground for these solutions. And I think this is really about trying to inform better decision-making within companies. And as Benjamin said, there are a number of different indices out there. We've obviously been working very closely with UNEP, WCMC, and other scientific partners, so we're very familiar with EII. And I think it's great to see you pushing this to the next level, trying to make it action-oriented, trying to make it feed into the decision-making process. And I think through our work and WBCSD and others, we're now starting to see a number of use cases sort of light up, right? Corporate reporting is just one of them. Target setting is another. Transition planning is a third. Investment into nature-based solutions is a fourth. Nature-based strategies, so, does the company have a coherent view about how it's going to manage its resilience in light of its dependence on nature's resilience? So we're seeing a lot of experimentation at the moment around different use cases, and I think these kind of tools and platforms can only help to enable better decision-making, which is ultimately what all of this is about. At TNFD, what we're trying to do now is focus, now that we've got a line of sight on the metrics, our focus is on trying to address the underlying data challenges, and even beneath that, at the sort of sub-basement level, if you like, is the measurement methods for the metrics that we think are really important. So we are now fundraising for a global nature data public facility, which would provide open access to the data layers that are required. And we hope that that's going to accelerate action even further. And at COP30, we announced, and WBCSD and Nature Positive Initiative have announced they're working on a greenhouse gas protocol equivalent for a core set of nature metrics. And that work has just been kicked off in earnest last Friday amongst a group of us coming together to make that work. So I'm confident all of the architecture's coming together, all of the pieces, the stack from measurement methods to data to metrics, and now this really vibrant ecosystem of nature tech tools that we're seeing, including this great initiative from the Landbanking Group.
Thank you. Coming a bit back to this initial thinking of, okay, now we are opening the data source to really get into the weeds. Now let's test use cases. Do you think, and maybe that's a question back to you again, Jessica, with your nature health perspective, this is a bit could serve like a compass, or where do you see our blockers that we have to be aware of? And then also to both of you in this space of collaboration, quality assurance, and curation of that very broad and wide space. What can we do as nature techs to really, really kindle that progress? I'm just coming from a table where I said, I'm so impatient. When I see what's going on there, I'm really impatient. What can we further do, and what should be on our priority list to get through that next step and to build that stack up to be really meaningful for decision making?
Great, thanks, Sonja. Great question. So I'll focus on our banks. So we have 385 banks who've signed the Principles for Responsible Banking. And the starting point for that has been the impact of their portfolios. And each of the banks are meant to do a materiality assessment and choose where are the impact areas from their materiality assessment where their bank is having the biggest impact, and set targets. So we have had a playbook from the climate landscape, which is financed emissions. Here is the one number, and then you can work towards that. It obviously has been a challenging political space for that topic right now, but in terms of having an operational way to manage that within a bank, there have definitely been gains made, and there have been lessons. Now, in terms of nature impact, we do have a number of banks who are piloting now impact targets for banks. And really one of the challenges has been the fact that, how do we prioritize across all these different potential ways of looking at nature for our portfolio? How do we actually do this? And I think having, a single metric that is comparable, that you can use between different sectors, that has resonance to a local space where you have that information in your portfolio, it can be extremely powerful. The side to that is that there is a challenge on the impact space right now. So we can have great data on impact, but it cannot necessarily be the thing that's moving the needle. So from a financial institution perspective, a lot of our strategy has shifted to make sure that risk and opportunity are there in that mix. And we see risk, continues to be an important driver for financial decision making, but risk alone doesn't get a bank excited. So, we've very much focused, for example, in our series called New Green Shoots, that's profiled, the latest innovations in nature finance. And, we really see the tech opportunities opening up this space. So in our communication with banks, I think it is very important to say, how can this bring new market opportunities in your portfolio? And there was the WEF study in terms of the 10 trillion in opportunities in nature positive transitions. What does that actually mean, and how do you do it? And I think many of the points that Martin made at the beginning, in terms of we're actually at a very sweet spot where the science and the tech are coming together, and there are also incredible new market opportunities in this space right now. And having the EII, having a KPI that we can use in different contexts that becomes familiar, it doesn't need explaining every time. Once it becomes familiar, can be extremely powerful.
Super. Maybe a 1 minute from each of you on how can we support and be those fire kindlers of
Fire starters,
getting
yeah.
fire starters to really get companies going, to get decision making going?
Yeah, so I think through our work on data over the last 4 or 5 years, we keep hearing a few themes keep coming up. One is the data in the metrics need to be understandable and they need to be accessible. We, particularly amongst financial institutions, we want to understand what's modeled and what's observed. And one of the issues that we're hearing from a lot of the emerging nature tech solutions that are emerging is from a customer perspective, so from the end user perspective, is the tools are great, but we can't see behind it. What's the metadata? What's observed? What's modeled? So I think increasingly what we're going to see as the sophistication of customers improves, so banks, insurers, investors, companies, they're going to be increasingly asking for more transparency and more access to the metadata that sits behind the tools and products that are being offered. And I think that's a really positive development. And particularly in the use of indices or indexes, the ability to disaggregate them so you can kind of pinpoint what's actually happening behind that headline number. I think that's going to be really important. And obviously, as I mentioned before, there's multiple use cases here, many of which are just purely internal, so informing investment decisions, risk management, etc. But when it comes to disclosure, the other dimension that's really important is, am I going to be able to get this through audit committee and legal counsel in order to make public claims, public disclosures? So the auditability of the data sources, the ability for a third-party auditor to come in and be able to trace back and say, I can verify, I can account for where you've pulled that data from and that data is reliable, is a really important characteristic. So I think these things are fundamentally things we're going to have to keep in mind. And I'll just offer one other thought, which is, as we've seen with any index, particularly on a 0 to 1 scale, as Benjamin said, really important to be able to understand, and for the audience, the end user, to be able to understand what is the difference between 0.6 and 0.7, right? Is that a meaningful difference? What happens if it falls from 0.6 to 0.58 or 0.52? How do I calibrate the significance of those changes over time? And of course, the great thing about an index is it can go both ways, and we want businesses to be not just understanding the pressure on the landscape, but also the impact of their responses. And so to the extent that we can be measuring change in both directions is very powerful, but we also have to be able to build the capacity for contextualizing what do these results mean. And so I think off the back of what we're seeing across the nature tech space generally, we're going to need to see a lot more capacity building and being able to understand and contextualize these results. Because, of course, as we've seen with credit ratings or any of those other sort of index-type tools, it's very easy for there to be multiple interpretations of the same number. Is a AAA credit rating good, or does that actually raise a whole series of questions, right? So it sort of depends on where you're coming from. But anything like this is going to require a lot of market calibration around understanding, so that ultimately it's not just about informing decisions within the company, it's also going to be about informing decisions between the company and its capital providers, and that means a much bigger audience of people are going to need to understand and be able to contextualize what these results mean.
You're quick, you said.
I'm going to be very quick.
Sorry.
And I'm going to say that in 3 words. Know your audience. Right, this requires systemic shift. So as you are catering for the needs of the CFO, know what drives them, know what they need, give them what they need, give them the reliability, give them the case studies, give them the business case. When you go out to investors, give them the investability, give them the reliability, give them the transparency. So I would simply sum it up as know your audience, because we're on a campaign.
Brilliant. So Benny, you were the first one, you may be the last one. One wish I heard, this is a lot of tailwind. It's tailwind for the transparency, for open source. It's tailwind for data accessibility. Everything that was said is just tailwind to what you've been pleading for. Let's go ahead with this. And I saw a lot of uptake in the LinkedIn. So what's your one wish when we come back next year?
Well, my wish is that it's not just me developing it, but that it's more people, and that in particular people have a critical look at how it works on different places on the planet, and start improving the models and start exploring where it works well and where there are still issues that we need to fix. And if we can really build an open source community around that, I think that'll be massive in order to pushing the whole story forward.
Thank you. And now we push the whole story forward. Martin, handing over to you.
Thank you, Sonja, and dear panelists, for laying the groundwork and establishing the base layer of the stack. Now, I really like this curtain. It's much easier to speak up. It's psychological. You feel more protected. So we need to do this. We need to do this again in the future. Now, I'd like to drive the conversation forward, and I would like to ask Chess to join me at the stage. Chess, are you there? So please meet Chess. Chess, he is a lawyer and he is a financial scientist. And he stands behind much of the work. He leads much of the financial products work that we do. He lives in Innsbruck and in Cape Town, so you can trust his judgment. So Chess, first, you work a lot with ecologists, zoologists, and ecosystem modelers right now. Did you ever expect that? How are you coping?
It's difficult to understand all of their interesting things and try and translate them to financial markets, but I'm learning.
Yeah, it's so difficult to understand them, whilst everything we say is so clear and evident, yeah, isn't it? Now, okay. Chess, let's quickly, before we go into those two papers, explain to us in the way that even I understand how are they different, and what is the fundamental statement or the fundamental bridge that you and the team and the community were trying to do that. On the one hand, nature risk pricing, and on the other hand, nature stock pricing. Help us with that.
So I think ultimately the goal is to bring nature into value in whatever shape that means, right? That can be directly onto the balance sheet as some type of financial instrument. It can be through the discount rate in a financial model, so on the risk side. The end result is the same. We're getting nature incorporated into price, into value, and price is the ultimate transmitter of information. So as soon as we internalize nature in that way, be it through the opportunity side or through the risk side, we're internalizing that externality. So to kind of ground it before getting into the detail of each, we have EII as the thing that measures the condition of nature. We have nature risk pricing frameworks that then translate the condition of nature into pricing signals for the risk markets. And then we have nature stocks, which allow us to deploy capital behind that condition. So that would be the overall sort of framework.
Would that also be consistent with what Jessica just said, that on the one hand, nature is this thing which helps us to reduce our risks, our dependencies. So basically, its value comes from what it can positively do for the economy. And the other one is around the opportunities. It's more about what it is, what its potentiality is, what the opportunity is that sits in it in an aggregate. Is it that those two angles that you were picking up?
And it's the overlap between how nature acts in different contexts, because nature is not one thing to everyone. We can think about nature from the reference point of it being the foundation or substrate that underpins all economic activity, and we can think about nature being a productive engine in its own right, generating productive outputs, and it can be both of those things at the same time. So if we start with the first positioning and we say nature underpins all productive systems, we're very much looking at it from the sort of durability or resilience angle, which takes us straight into the risk world. So that's where that risk building relationship comes from. And then if we think about nature as a productive engine itself, not in the sort of traditional or historic extractive sense, but some instance of productivity where there's no trade-off, we can think about opportunity. So packaging nature itself as something that generates economic output, and that would be the different framing by which we go down these different routes.
NRP, nature risk pricing models. So that's your new hobby. Now, help us to understand. On the one hand, we are reading reports like yesterday that the planet might go into water bankruptcy. And it's so easy to relate to that, that this, of course, must have effects on asset valuation. And still, at the same time, we struggle so hard to see any signals, and I'm going to ask sort of the panel later again that question, question. It's so hard to see how that translates into discount rates, how that translates into credit approvals, how that translates into capital allocation. What was missing, and what sort of is taking place right now in your mind, how that could be closed, that bridge?
I mean, not to plead to this audience, but I think the missing ingredient is nature. And when I say that, I mean climate stress is an external force that is kind of creating impacts on a system, and nature is the thing that receives that external force. So nature in that sense is acting as a sort of directional modifier. It either amplifies or dampens the effect of a climate shock. So the logic then actually becomes quite simple in terms of the mathematical relationship, as in you have climate shock of certain magnitude, nature of certain integrity. What is the resultant output between that interaction, and how does that output impact businesses that exist within that landscape, for example? So the resultant output creates some type of economic opportunity or consequence for the business, and that is a function of nature's integrity and that business's dependency on integrity. So it's creating that mathematical bridge to go from composite EII nature condition metric to risk signals in finance, and how can we do that in a meaningful way at scale, all those types of things. So it's really that what's missing, I'd say, is nature in the equation, because we're seeing early signals of climate stress being priced into financial markets. It's noisy and it's coming in lots of different ways. We're seeing it in insurability. We're seeing the central banks reacting. Just October last year, Bloomberg published an analysis showing that public companies are being charged a higher cost of capital on average by 22 basis points that are exposed to physical climate risks. So it's just expressing that physical climate risk in a way that considers the resilience and durability that nature provides.
Let's move over now to nature stock pricing. I think it's fair to say that we are all unhappy with the instruments we have right now to give value not just to the nature that we are rebuilding, but also to give nature that is fully intact, high integrity. And Ashley and Akim and a few others probably will have very enthusiastic opinions about that in a moment's time. So we agree on that currently we haven't found that instrument. Now, sort of you have created something that basically rigorously applies financial option value thinking to a nature stock as a new asset. Now, what is it that I'm holding in my hand if I buy it, if I invest into it? What is it?
So I'm going to start with the logic and then get directly into what it is. But the logic's quite simple, and it's borrowing logic from financial markets that any of the sort of VC or early stage private equity folk in this room will know and appreciate. Any economic engine needs to generate something to look after itself, and that's typically generating cash flows, right? Revenues, whatever it is. And that thing needs to generate those to maintain itself, to improve itself, to build itself. Nature needs the same, right? It needs to be able to be rewarded for the things that it produces in such a way that it can maintain itself and we can steward nature into the future. But how do we get money in today when some things, when there's thin nature markets, for example, people aren't necessarily willing to purchase nature outcomes at scale just yet. So the same way an early stage company raises capital or is capitalized based on future value, we're creating an instrument that allows the holder now to participate in the future value based purely on ecological performance. So it's an attribution right to the ecological data that comes from high integrity nature, basically, on the bet that performance data is going to become valuable at some points as nature markets mature and develop. So it's creating the instrument now to move capital behind nature before nature is able to bring in cash flows for itself based purely on nature market transactions, so non-extractive type of mechanisms.
And dear panelists, I'm going to quiz you on that in a second. I hope you listened well. Now, and we have to move on now. Perhaps the last question to you, Chas. We all agree that this is a fairly fundamental shift. It's a new way of defining wealth. It's quite paradigmatic. It breaks with many premises of our current economic school of thought. What would it take to get there? First of all, we understand it's an act of systemic change. Fiona said it very well. That's why we need to work on it together as a community. But sort of when you are sitting there over your model, sort of what is it that you would like to see more of to build more confidence faster, and so it's easier for a fiduciary player to adopt some of this?
Oh, loaded question. I think one of the things that is very important is designing now for scale, right? So not limiting ourselves to what is known in our design choices that we make today. So it's really, and that's the beauty of it, it's borrowing sort of boring or vanilla financial markets logic and packaging something new within that framework, right? So we're not creating something completely new that financial markets have to adapt to. We're taking something new and packaging it in a way that financial markets understand, and packaging it now for that future scalability. So it's really then about how do we get the initial sort of ball rolling and get the flywheel spinning, because we need initial uptake to get the market to start kind of running itself, and then this thing runs away from us and becomes very real. So it's that initial uptake. I think we need some brave people there that are willing to try. Yeah.
Thanks, Chess. And before I ask you to applaud, he told me that he loves writing papers and doing formulas. He hates the stage, and that's why we have this. There's a second reason we have this curtain, because I didn't tell him there's anyone sitting behind that curtain. Thanks a lot. Now I would like to ask my double panel to join me. And please just come up. We have sitting over there, we have His Serene Highness Maximilian, Prince of Liechtenstein. He is the chairman of LGT. We have Michael Brückner. He is the CEO of Munich Re Investment Partners. If you want to sit there. And then we have Mark Titterington. He's the Director General of Eurospirit, and he stands for the food and for the beverage industry in Europe. So join me here, please. You are Team Risk. Yeah, so because we assume you're sitting there day and night scratching your head over all these unpriced nature risks, and so basically that's the ask that we have to you as a team. But at the same time, we want to mirror that with those who are thinking more about the intrinsic value of nature, and so I would like to invite Akim Dauda. He is the founder of Vena. And then I would like to have Ashley Kami. She is, if we go back a long way, and she is the initiator of the High 4 initiative at the World Conservation Society. And so let me sit here, then I can sort of make sure that I have a view on both teams. Thanks for joining me. Maximilian, may I ask with you, or start with you rather, apologies. And I can't start without asking you this very fundamental question. I mean, you are the chairman of LGT. You lead investment funds such as Lightrock. You do venture philanthropy. In many ways, you are looking at different capital stacks to invest it into new opportunity. And you also, with your family background, have probably a thing or two to say about the question, how can you actually reconcile long-term and short-term success? Because everything you do seems to be fairly successful, even in a shorter in a shorter time horizon, and yet you have chosen to take a very long-term stewardship perspective over those entities. Now, much of the nature discussion is about we can't afford it because it's not creating those short-term benefits. So give us the benefit of that practice that you have developed of balancing the long and the short term.
Yeah, I think for us at LGT, it has worked out incredibly well. And to give you a couple of examples, to build a business in Asia for a private bank that is profitable is impossible to do in 5 years. But over the long term, over 30 years, for us, it has become a huge game changer. So as an organization that takes a long-term perspective, we decided to go down that route. There are probably 2,000 banks in Europe. We all saw that the Asia growth is a long-term trend. I would say out of 2,000 banks, probably 50 have tried it, and then a handful have succeeded. So the rewards of sort of looking at the long-term trends and then thinking how you play them, I think can be very, very substantial and can contribute in a very significant way to create a lot of value. I do think that sort of you have to understand that it's a long-term game, and you have to play it accordingly, and that often also means play it sort of sensibly. So if I look at what you have produced, basically you're providing a very sort of innovative and new information into the market. And I think you should apply to the sense of responsibility to as many as there are out there who are all realizing that if you look at the overall value creation over the last 50 years, it was pretty good for equity investors. But when we look at natural assets, we have probably destroyed sort of 30% of whatever the value would be if we could attribute one to it. And we all understand that we have destroyed so much that it's starting to really hurt us. And we cannot continue like that. And so we need to be responsible in the way we try to address the challenge. And that means also adapting, trying sensibly. And I think getting the adaptation out there is going to be incredibly important because how the financial markets, how the ecosystem is going to adapt to this new information is still a bit difficult to forecast. But I think where I have confidence, and then I shut up, is trying to be responsible in that space. We have developed at LGT an ESG index. Like you, we've sort of debated, sort of how can we best put that together in an intelligent, smart way? How do we calibrate all these things? And we have come out, people actually liked it. Nobody got too pissed off, with few exceptions. So by and large, it has created some value for us. The problem was that our ESG index and the ESG index from other providers have been too far away from each other. I think what you are doing is going to be much more comparable to Moody's and S&P. Yes, slightly different methodologies, slightly different indices, but you're not going to be that far away from each other. Because I think while you have invested a lot of time sort of how to calibrate and so on, there's less judgment in assessing nature than there is in assessing governance. And so ESG was too broad. And so I think that's where you're going to be, hopefully, more successful even than we have been, and hasn't hurt us. And I hope you will be very successful. And I also hope that we're not going to have 500 indices. And that's where adaptation is going to be key, and that's going to be, I think, critical for your success.
Thank you. Michael, you are with Munich Re, and as I said before, you are the CEO of Munich Investment Partners, so you are the investment arm, you are not the underwriting arm, and yet help us to understand how this conversation is relevant or not to a reinsurer. A reinsurer sort of to us feels like that heavy balance sheet of last resort for some of these fundamental trends that are happening out there. So give us a sense of where that conversation currently sits in your world on both sides of your activities.
Sure, thank you. Like we are Munich Re Investment Partners, as you said, so I'm kind of representing like Munich Re's answer to kind of making climate change investable. And I think we heard a lot of right things. We have, when we look at the data which is currently available, we have to face that things are changing. Things are changing with regard to the patterns we see. We have to face that the models we've applied in the past may not be accurate anymore. And we may see also what you alluded to. There are so many banks and financial institutions running different models. For example, when you look at the NatCat report, which was provided by Munich Re last week, we've seen a very interesting pattern here. And this speaks to kind of a lot of observations made today. We've seen that essentially we have a peak here. So H1 last year was a peak here with regard to so-called secondary perils. So secondary perils are like wildfire, bushfires, you know, flooding, something which usually doesn't really cause a lot of harm. It is like more noise and damage because damage quotas are so low. The amount of damage incurred by that was even higher than the peak perils, so meaning like the hurricanes and all the things we think of when we think of, yeah, there was something really, really, really catastrophic going on. So we see that there's a change in the patterns of behavior, and we see that if you look at this and you look at how you price your assets, then you have to understand that you have to change your approach to this, because when you're not modeling these secondary effects of nature and the secondary effects of physical climate change, then essentially, you know, you will be mispricing assets.
Thank you. And it strikes me that, of course, we are getting better and better in understanding those risks. And sometimes when I look at it, I feel that we are able to price accordingly. So I think that even sort of a bit of risk pricing also has helped your underwriting business. But then at the same time, it also strikes me that we are almost pricing ourselves out of a lot of historically insurable activity, and we are moving into structural uninsurability, because it's not just that we are trying to insure against sort of a steady trend or a steady line. We are up against a trend here. Things are getting different, and they will be different as long, and then I'm coming to the investment partners, we are reinvesting into bringing this risk back down by creating thriving ecosystems. Is that a discussion? Because in a way, you are sitting on the perfect platform that could, A, invest into better understanding in risk, and then also be a major investor into that aggregate called risk reduction through nature. Is that a strategic line of thought?
Yeah, let me put it like this. If you look at the exposure of certain assets in the world, right? And this kind of is one of the building parts on how we assess bottom up, essentially, you know, the value of organizations like our investments. When we look at this and you have an asset, and essentially the value of risk of that asset is essentially a function of the hazard, the exposure, the vulnerability. And what you guys are doing plays into the latter bucket, because that is essentially the vulnerability comes with where does the asset essentially sit. And there's like a lot of things which are relevant for this, but very relevant as well as like the larger ecosystem, the quality of nature, and so on and so forth. Because when you look at the vulnerability curves, you see that assets sitting in essentially like in a high quality nature environment, in a good ecosystem, they may be able to withstand physical shocks much better than those which are at the other end of the ladder. But here we have, even we see that this is relevant for, at the end of the day, then pricing the stock sensitivity to physical asset shocks. We see on the nature side of things, on more the complex data side of things, meaning soil degradation, like ecosystem, like interrelations. There's like not much currently available. There's like much more we hope will come. Like therefore, kind of we're looking at things you are doing. It's like to say we need more to better assess this, and we need also more data with regard to what are the actions, what are the policies of names of stocks in place to really improve their actual situation.
And to sort of probably make it even more specific, you have an index, and if on that index you're at 0.2, you might still get an insurance, but it's going to be at a premium of X. If you move it to 0.4 or 0.5, your premium should be a little bit lower, right? That's how going forward, ideally, decisions should be made. And I think it's realistic. I mean, if we look at the insurance and reinsurance markets in the flood-exposed, hurricane-exposed areas, there's just certain locations that a couple of years ago, they would still get insurance. With insurance, they would still get leverage. Now, I don't get any insurance anymore. I don't get any leverage anymore. And the pricing of those properties has totally diminished, and this will go further. And I think you are bringing an instrument to the market that allows more granularity in this type of assessment. So it's in the broader economic interest of those who need to price risk, but also those who are taking or having the responsibility to set the rules of the game to make sure that those type of informations are being spread, assessed, and taken into consideration.
Can I very quickly, and before I come to you, Mark, ask for a very short response on the following? Both Michael and Maximilian, you both have you seen moments where something that had gone unpriced went priced? So have you sort of, because cyber risk sort of became manifest at a certain moment, and we weren't prepared for it, geopolitical risk there. So what does it feel like, and what has to come together for such a moment to occur? What can we learn from that?
Yeah, I would say sort of if you have big swings, if there's no more water, and we have a water business in our impact investing portfolio at LightRock, in Brazil and in Sao Paulo, and they're just excellent in extracting water responsibly, and then also recycling it, and they go to all the sort of big water consumers, industrial water consumers, and they say, look, we offer you a more secure and better and safer supply of water than the state-owned company, because the state-owned company, if there's water shortage, they always do one thing. They reduce the pressure in the water system, because a lot of water is lost in leakage. And the leakage is directly correlated with the amount of pressure that you have. But if you're taking a shower in the morning and you're running a high-end hotel, or if you have water businesses where you need to have pressure and a lot of water, and no pressure, it's not so good. So you're willing to price up.
Yeah. So water risk as from unpriced to price. Anything that you could think of?
Yeah, I would take a look from a higher level. The markets are constantly looking for unpriced risk. Markets aim to be efficient. They look for inefficiencies to exploit inefficiencies. They look to see what's mispriced to make a profit out of it. This is the basic idea of how markets function. So if there's something which is not priced correctly, and there's an understanding and there's solid data, markets will jump on this automatically because this is what they do. And then they will jump on this, and then they will make it efficient, at least to the extent possible, right? But this is an automatic reaction of how the investment markets or financial markets, broadly speaking, work. So when we get to the point with these nature risks, with nature, generally speaking, doesn't matter, but if you offer, or if the markets identify this as relevant, as inefficient, and as investable, then they will go there and then we'll take it up.
Thank you. Now, I have followed a very popular trend of talking about the real economy last. Mark, you have experience in Syngenta and Indigo, which is a very interesting company to know and to look at. And you are a founder of the Forum for Future of Agriculture, which is one of those very constructive places where you can discuss even very contentious issues like agriculture. And now you will speak on behalf of Eurospirit, which is one of the lead, basically, for many of the beverage producers in Europe. Now, these risks that we talk about, the water, Maximilian just talked about it. Are they really hitting it today, or is it just something that we want to see because we like the WEF risk index so much? Or is it where is it already very real, very tangible, very manifest in the way the industry is evolving, and how is it a top-of-mind issue?
Big questions, Martin. I mean, I've spent my entire career pretty much in agri-food, working on this point of how do you get farmers incentivized and rewarded for the delivery of their environmental public goods and services that they provide. I've never been more excited by the amount of interest and indeed money that is starting to come in to support farmers in adopting practices that deliver measurable and verified outcomes. And I'm convinced that has happened over the last 4 or 5 years, admittedly through the risk prism that is pushing companies both within and beyond the agri-food value chain to invest. Why? Because it is inherently is a long-term business. You have to secure the surety of your supply and the resilience of that supply, whether you're in cocoa and you're in coffee, whether you're in corn and beans. You've got to do that over the long term. And the rotations force you to do that over the long term, more in certain parts of the world than others. And I think many of the companies have started to see that surety of supply is under risk. Not necessarily from the kind of one-offs that you talk about, Michael, quite rightly, yet the storms, the hurricanes, the floods that we see, but because with growing incidents, you see that you can't get into your field to put your winter crop down until late November, and that either you lose that crop or you lose your yield on it, and that impacts on the supply chain of the off-takers that you're going into. That is a very, very real risk. I think the second thing that has driven this is that as that has become seen and known, and I come from the sustainability space, we transition away from looking at it from a responsibility of the chief sustainability officer, chapeau to all of those that push the agenda when no one else would listen, into the chief procurement officer and the chief financial officer, now looking at it as a business risk. And so I think that, whether you're Nestle, whether you're PepsiCo, you're moving into that direction. If you look beyond the value chain at companies like Google, investing in data centers, energy intensive, water intensive, how do they replenish water tables around their data centers? This becomes a business risk, a business mitigation piece. So I think that is driving the amount of investment that is going in. There's some fundamental challenges with it. We're not all talking about the same data. Is it credible? Is it robust? Is what I'm talking about the same as what Michael's talking about, the same as what Maximilian's talking about? Generally speaking, not. Even though we've got some very good examples, and I would say Indigo is one of them, that started with carbon credits and extended. we've too many of these, and that's why I think we're very excited about what you've done at the Landbanking group. The other challenge with it is we're still looking at very linear. So if I'm a food processing company, I might want that part of the crop rotation. Well, the farmer doesn't just think of what crop he or she is growing in 1 year. It's across the whole rotation. So how do we take a whole farm or even a whole forest perspective? These things kind of get in the way. And then thirdly, to just switch the dynamics slightly away from the way into it is risk and resilience, but the opportunity that is being created here to create multiple lanes of revenue generation for farmers and land managers is an opportunity. The tools and technologies that they're going to need to deliver these ecosystem services is fantastic. And these businesses are going to be much more investable, in my view, from when they do the right thing. So I want to change that lens a bit from just looking at the risk to the opportunity. But what's going to be key to all of that is understanding that what we're actually measuring and valuing is, as far as possible, outcome-based.
Help us a bit to understand also the softer side of that issue before you already handed over to team opportunity in a second. What is really needed to inform very different parties that currently are not meeting in trust? From the conversation with the farming community, from the conversation with the financial community, we were very clearly what kind of data you need so that you can work with it. Everyone has a bit of that. So what's your guidance also to the community here, that the nature tech, the nature fintech community, the enabler community, to make sure that we are gathering broadest acceptance in a world that still needs to be connected and bridged because it hasn't been yet?
The problem with that question is that it inevitably invites a subjective answer. So I'm going to give my subjective answer and everyone else will disagree with it, and that's fine. I mean, we've got to keep it as simple as possible, frankly speaking. We tend to drive for perfection. We did that a bit in Indigo, actually. Perfection became a bit of the enemy of the good. So we've got to keep it simple, avoid letting perfection be the enemy of the good. I think Tony said in the previous panel, transparency is absolutely essential. And I think verification and auditability has to come into that as well. And as I've said just a moment ago, as far as possible, outcomes is what we should be rewarding, not just practice change fundamentally. Now, in some areas, we'll have to go with practice as a default for outcome. That's okay. My final plea would be, for the farmers and the land managers, the land stewards, man, they've got a lot that's coming down on their shoulders. Back to that simplicity point, I hear from so many farmers and land managers, just tell us what you want. We can deliver it, but we need to know what you want, and you've got to stick with it. Don't move us around so that we know what we're aiming at.
Thanks. Over to team opportunity. Ashley, so you're an accomplished environmental scientist. You work for one of the most respected global conservancies, the World Conservation Society. And you have been very articulate how there's a misconception in the way we are funding standing ecosystems. So, and that was also the trigger when you started, or when under your leadership, HI4 initiative was started. What's that misconception?
Yeah, great question. And just wanted to thank you for joining, and congratulations on the EII. I'm very excited about, all of that, what it's going to bring to, I think, what everyone has spoke to today. So in case, everyone in the audience doesn't know what HI4 stands for, it's the High Integrity Forest Investment Initiative. This was an initiative started a few years ago by the Wildlife Conservation Society to really think about how do you scale investment in standing tropical forests, very large, intact, with high ecological integrity. So if you think of a map, the areas that are actually left that have high ecological integrity on a large scale are some parts of the Amazon basin, a very large chunk of the Congo basin, and a very little bit of Southeast Asia. But realistically, and I think, we've talked about this, there's large amounts of deforestation, a lot of work going into restoration, a lot of work, through the voluntary carbon market, looking at avoided deforestation. But then you have these really large intact tropical forests that exist. And up until now, we haven't had a mechanism to think about how do we think about finance beyond just philanthropy? You know, it's consistently and historically been philanthropy, some levels of government investment, but if we really look at these areas, you know, we haven't been able to come up with a mechanism for that. And why do we care? Why does it even matter? I mean, I think that, you know, we know when we think about these areas on different levels, we think about them on local ecosystem services. And, you know, you were talking about farmers and really the different types of practices that farmers can do and regen ag and the opportunities that that brings. And those bring in and improve certain ecosystem services. And then you've got a lot of companies that are thinking about the region, right? They're thinking about their landscape footprint. What does that mean? You know, not just the risk, but also, like you said earlier, the opportunity. But then if you step back even more, you know, you've got this much larger sort of ecosystem that we're looking at where you have very large intact tropical forests they're very much a part of this. You know, when you think about corporates and the private sector, they are not only risk, but they're very dependent. And so there's been a gap in the science that has been incredibly challenging, which is one of the reasons I'm excited about the EII. We work on what's called the Forest Landscape Integrity Index that focuses on tropical forests and human pressure. But these metrics are so incredibly important because we really need to think about connecting these different areas and connecting these and not just thinking about where we're working on the local and regional, but also that much wider landscape, because there are huge ecosystem service flows. You know, we're all very familiar with carbon, of course, but rainfall, you know, that is an incredibly important ecosystem services. You know, all of the commodities are very, very dependent on that. So you mentioned, you know, cacao, for example, hydroelectric, you know, when you think about energy security, they're very, very dependent on rainfall. And we really haven't had the science and the modeling up until recently to be able to make those connections. And it's really new and really recent that we're starting to see that science evolve to be able to bring together all of these different actors. And I feel like a lot of the conversations and panels I've listened to in the last day or two have been talking about that. And we've got people looking at metrics, we've got the tech, we've got the science, we've got the economics and the finance, but bringing everyone together to really think about how we utilize and structure and incorporate the value of ecosystem services into not just the work that corporates are doing and how they're thinking about their impact and their risk, but these larger sort of financial mechanisms that have been discussed earlier. And really that idea of, you know, putting nature on the balance sheet, how do we actually do that? And I think, you know, it's really just, I mean, I've been working in this space my entire career. It's really just recently that we're starting to have the right pieces and be able to bring those things together. I think from our perspective, you know, these pieces, these very large intact tropical forests are so critical. But because we're talking about maintenance of ecosystem services and not about uplift, it's very challenging. You know, it's very challenging. And so I think all of these different pieces and tools like the EII are moving us in that direction to be able to really think about how do you adequately work with, you know, small-scale farmers and the ecosystem services they provide because of looking at those commodities, but also these very large intact tropical forests, because again, there are people living in these areas, there are stewards that are maintaining these areas. We work with Afro-descendant communities, we work with indigenous communities, with state and national government. And so again, coming back to, you know, whether it's a farmer in a specific case or it's an Afro-descendant person in Brazil, they're the ones that are really responsible for the maintenance and the improvement and the provision of ecosystem services. And so we need to really connect all of the different pieces of that.
Akim, before I come to you, actually you're saying something quite interesting, because there's one worldview which says, look, there's the world of private goods, and whenever nature starts to bite me on my private assets, then I'm starting to work on it. And then there is the world of public goods, where I will never do anything because it's someone else's problem. But it strikes me that increasingly we would have to think of that much more of a fluid or concentric model, where every risk is also your risk. And there are small balance sheets and direct risk relationships, and there are big balance sheets with more indirect risk relationships. And every time those big risks, and like losing the forest in Gabon and stopping the river Nile from flowing, would then also sit at least with some allocation, sit in anyone's exposure. And currently, we are saying it touches me at zero, and it's a non-zero number. And through that, one could think of it as a very connected problem, even if I created two teams here, those who are trying to give value to that high integrity and to the presence value of nature. That brings me to you, Akim. I'm very happy that we met. There's always so much interesting things to learn from you. You are very interested in also in the Congo Basin. You have been the CEO of the Sovereign Wealth Fund of Gabon. Gabon happens to be the ground zero of tropical rainforest. So before we go into financial engineering, which is also something that you do, and you also might want to talk in investing, you talk about that. First, acquaint us with the real choices that a country like Gabon has at this point in time, how to deal with its forest.
Okay, thank you. Thank you, Martin, and I'm very, very excited to participate in this critical conversation. Let me maybe start you off with an anecdote, which really shows the challenge that biodiversity-rich country like Gabon face on a daily basis. A couple of years ago, I think it was 3 years ago, with the former president, we did a visit in the hinterland, right? And at the time, we were really, how do you say it? Our elephant population, because again, Gabon is a carbon sink. We've been really implementing groundbreaking policies in terms of conservation. We have the largest population of elephant forest on the African continent. So it was always an element of pride. We'll come to places like this and boast about it. So that day, we went there, and there was an elder. He came to the president and said, Mr. President, we heard that you passed a law to further protect the elephant, which is great, but who protect us? They destroy our crop, our kids go to bed hungry, we fear for our lives. So if you like those elephants so much, next election, ask them to vote for you. So that's really, those are the challenges that a politician or a leader of a country faces on a daily basis, because now you have your budget for conservation that is competing with your budget for schools, for hospitals, for roads, right? And to the point that Ashley mentioned earlier about standing forest, you have Gabon today, which is, we have a net sequestration of 100 million tons of carbon every year, which is, in terms of perspective, it's a third of France's emission, or a fourth of the UK emission that is being absorbed by the Gabonese forest. But at the same time, we can't monetize them on the voluntary carbon market because we don't think the additionality criteria, which is based on the fact that it's a system that is built for the bad student, basically, right? You maintain your A plus, you don't get rewarded, but you improve your grade from D to C, you get rewarded, right? But it's also based on a faulty assumption that what is there today will be there tomorrow, which is not the case. I won't mention them, but there's some countries not too far from Gabon that were carbon sink 15 years ago, and today they're net emitters, right?
What would actually have to happen, and I'm increasingly trying also to connect the two conversations, I think we understand a world in which nature is a very effective tool to reduce risks, and that's why you want to invest into it, so to protect your assets and your supply chains and your valuations. Now, if it's true, and I think it's as plausible to think about what the two of you care so much about, to say that nature is this wonderful carrier of long-term opportunity, and we have many markets in which we are able to deal with that. We have option pricing theory, we have equity products where you don't know exactly where the revenue comes from, but it might come someday because you have a positive hypothesis about it. And nature is one of those things. The possibility of a thriving Congo Basin is infinite for the future of economic Africa, etc. And so being invested into that intuitively at the value of that future opportunity feels like an intuitive, rational thing, more than sort of being just buying a carbon credit. And this is not a meeting to criticize carbon credits, but it is a financial tool that has been developed for a certain purpose. And here we are discussing the maintenance of standing forests. So what would that have to be? What would that kind of contract have to look like to be acceptable for the communities, for the government? government of Gabon or any, or DRC or any. And at the same time, Michael and Mark and Maximilian, how would that have to be designed to be an investable proposition, to have a right on that long-term opportunity, which is things that we do elsewhere?
Can I start? Yeah, very good question. And I think we can also tie that to the work that you're actually doing, right? Because what we need now, I mean, the solutions are limited now, right? We're seeing either public funding, or we have grants or international support or project-based mechanism. But all those are really tailor-made in terms of transaction costs. They're pretty high. Due diligence takes time. And it's not industriable, it's not repeatable, right? So what we really need now is to be able to build the stack, like the infrastructure that will allow you to repeatedly generate those revenue that will help a country like Gabon, or even from other countries from the Congo Basin, to manage that nature in as a strategic asset to perpetuity and with predictable revenues, right? So there's several points, like, I mean, you will talk about the element of origin, the element of reliable data when it comes to at least those environments which are not a national park in Switzerland, right? You have the element of how do you measure performance, like those conversation around MRV, and you also have the how can you manage and predict the risk related to such asset, because that's actually how asset allocator allocate money, right? So, but I'm going to quickly finish on that. The good part is we have the technology now. The technology is there in terms of capturing data, satellite, I mean, even the work that you're doing with EII. The cost is being reduced as well, and we have full traceability. And I'm going to quickly just double-click on another element of risk that we're not really talking about a lot, is the origin risk, right? Because when we look at nature, value is being captured downstream, right? When we create IP, when we create product. But nothing goes back, or there's no participation of the upstream. So talking about the ecosystem, talking about the countries and the communities, right? So if now within the stack, you have a foundation that look at that risk, which is actually a regulatory risk and a future reputational risk, and also a going concern risk. I'll give you a quick example. You have companies today that are building largest database of biological materials, right? And they use AI to generate new DNA structure to create new drugs, or even material innovation, or even in the defense sector. But what happened is there's no flow back to the country of origin where the first DNA sequence come from, right? But if we don't do that, you have an ongoing concern on your actual input, because if money doesn't flow back into maintaining those ecosystems that are actually informing our future research and innovation, you have a problem.
Yeah, and you are sitting on all the genetic wealth. And let me start with you by a final round that we need to finish on time. And return to the idea of this being an academic review board. And so now sort of we've presented an idea and you are sitting there, and now you have the freedom in a very in very generous terms sort of to give us some homework, and said, look, here is an element that you could work on even harder to be even more relevant to what we are trying to achieve. Because your mission is to make sure that this is really a source of funding, and that it's being a broadly accepted funding instrument, also way beyond WCS. So what is it that we now have to do to make sure as a community to be helpful to all of you? And let's quickly run this through, starting with you, Ashley.
Yeah, I'm going to give you two, even though I only have maybe time for one. So one thing, and I think this is maybe just jumping off of what you said earlier, is that, you know, there's definitely a need for simplicity on sort of the financial structuring side, but we often haven't been talking much about on the community side, right? So it's like there's the structuring and all the things and the different metrics, and it's incredibly important that we're able to really think about how you streamline that. But the ask on communities, the ask on farmers also, I think you said this, they have a lot coming on them, right? The farmers, so do these stewards of intact tropical forests. And so we need to be mindful of that as we design and think these things through. And I think the second thing is a challenge I've been running into quite a lot in the last few years since I started this work, which is, there's a missing piece when we think, again, not necessarily on the local ecosystem level, but we think on that sort of larger regional and landscape level, and connecting those flows of ecosystem services to financial markets and also to the private sector and the different commodities, and really thinking about, for example, rainfall, and how does that actually connect in these regions. We know that there's a large dependence.
Attribution.
Exactly. We know that there's dependence, but we haven't been able really just recently to think about, cocoa and rainfall coming out of the Congo Basin and the importance for the cocoa sector. So we need more of that.
Mark, what's your guidance? Must work harder.
I think it's going to be picking up on what you were talking about. I mean, the fundamental defect in the voluntary carbon market is the additionality point. I would absolutely concede that. And there we allowed, maybe the rules became perfection rather than for the good. I think what we've learned through that, particularly in terms of the measurement and the verification tools that we've developed, I think have got the wider utility that we've all been talking about. You take that at a landscape level, whether it's maintaining or improving forestry in Gabon or improving the Mississippi Basin, who benefits from that? I mean, identify your audiences, who benefits from it, and therefore who needs to pay in, who needs to be rewarded, and who needs to pay in, and what does that look like? What are the instruments that we need to create that make that work together? And I think the guidance there is, some of that is going to be corporate investment. Some of it might be from the insurers. Some of it might be from the banks. Some of it might be from a much more creative use of the tax system. We have a huge amount of public subsidy going into agriculture. Arguably, not all of it well used. How do we target on maintenance and improvement as well as the new stuff, or what do you call it, the bad boy reward? Fully agree.
Short thought, Michael?
Yeah, perhaps very, very briefly. I think we are all humans, and like what we have to do is, like, we all want to live in a beautiful nature. We all want to breathe good air and so on and so forth. But at the end of the day, we don't price that. So we have to move like nature out of this tragedy of the commons trap. And then just to get it to something where you would like to attract large money to. But then you have to prove that there's a solid basis for providing returns, that there's something which is really adding value, just like in your discussion with us, you were kind of alluding to this. And this is essentially where we have to get to. And I think we're on the way. There are a lot of things which are done to make that happen. But I think there's still some way to go.
A thought?
Yeah, I think if I look at the progress over the last sort of 5 to 10 years, I think the measurement systems have improved dramatically. And the lack of those have really stopped what was otherwise a pretty promising development of the voluntary carbon markets. So I think we need to sort of get it out there, make it clear that we are now in a much, much better position to assess and value things. And then we need to start to sort of focus on sort of the different categories of assets that are out there. Because in the business case, or the propositions that make sense from a global value creation perspective around conservation of the rainforests are going to be very different from upgrading and changing our agricultural practices. And so I think that's also something to sort of think about, trying to fix everything, but pick the couple of categories and then work with the key stakeholders in those categories. Rabobank, when it comes to agriculture, African parks, as I know you do, you're doing all these things probably already. Normally, when I come up with an idea, you have already done it. But I think categorization is going to be important because that otherwise becomes too complicated.
Thanks a lot. I found this a truly instructive panel. Thank you so much. I learned a lot. A very interesting situation has arisen now. We are sitting here and we have no clue whether the audience is still there because we can't see them. Okay, we know in a minute. For now, let me just thank you. I think hopefully it was a good blend between a technical conversation where we say what is it that we really need to do, not on a philosophical but on a very technical scientific level, but at the same time that we are lifting it up into the big conversation it is. The being able to give value to nature is, next to overcoming income inequality, one of the two fixes that our economic system needs, and wrestling over it is the most deserving conversation I could think of. So thanks a lot. Back to Felix and to an outro. Thanks all of you for joining.
Turns out, nature matters. And guess what? Long-term thinking works. Nature is the world's most undervalued asset. Across the globe, natural capital is at risk. And still invisible on most balance sheets. Until now.
Nature isn't just beautiful, it's essential. And now, for the first time, you can invest in it. On the Landler platform, we've combined the latest advances in ecological science, nature data, and portfolio management to turn ecosystem integrity into an investable asset, backed by a community of visionary investors. Position yourself at the forefront of a movement that's shaping the future of finance and the planet. The future of investing is here. Secure your spot today.
Thank you so much to the Landbanking Group, to Martin and Sonja, and to the esteemed panelists. And I'm sure the whole audience was captivated just as I was. Could I please ask all the speakers to come on stage so we can do a group picture? Thank you so much. Thank you.